Okay, we're now going to quickly do it for all the others.
So if you have a look at the S&P 500 versus crude oil here, can you see it's a very similar relationship as what we had from ice cream sales, right? Ice cream sales versus temperature. As the temperature rises, we tend to see an increase in ice cream sales. The relationship is very strong, right? 96% explanatory power the temperature has on ice cream sales. We're seeing something similar with the S&P 500 and crude oil, right? Now you may be wondering, why don't traders just look at this and say, hey, it's positive, I can see that here. Because firstly, you don't do a scatter plot, do you? You just have crude oil going up and you have the S&P which might be going up, okay? But there'll be some, do you see there might be some slight, it's very difficult to sometimes visualize clearly just how positive or negative the relationship, if any, because you're not doing a scatter plot, right? You're just looking at the price versus another price. It's like trying to compare two charts and saying, is there any correlation? You can visualize it, all right? I'm not saying you can't do that, and we're going to do that together later. But it's much more difficult when you've got prices moving around. So it's nice to have something in graphical format, like a scatter plot, which is what we do here. But more importantly than that, we're looking for this number, okay? We're looking to see how do they co-vary. It's all to do with how do they co-vary. Is there a relationship? Is there a statistical number? You know, it's almost like if you remember the standard deviation, it gives us a number that we can compare, right? So it's two things. It's on an absolute basis, do I have a number, you know, between -1 and 1? Obviously, -1 being very strong relationship, but a negative relationship like this, that'd be -1. Or it's not -1 because it's not 100% straight line. Obviously, there are some variances here. Even here, you can see some slight variances. But how strong is the relationship? So that's on an absolute basis, because then it helps you determine, is it worth me even looking at crude oil if I'm trading S&P? You know, if the relationship is all over the place and we're getting dots all over the place, like we do below, here, do you see that? I would expect that to have a weak correlation, and we'll talk about that. In fact, why don't we what I'll do, let's get the calculations down, and then we can have a discussion, and you'll see very clearly why we are calculating this number, because not only it helps on an absolute basis, which I just talked about, but also a relative basis. So I will just mention that here before we talk about it again in terms of interpretation. Between that and that, how can you tell the difference? As in, which one has a stronger relationship? And forget about this saying ice cream sales and temperature and this saying crude oil. It doesn't matter. Just imagine visually you were looking at two sets of data that plotted X versus Y like that, and two sets of data that plotted X versus Y like that. You couldn't even see the numbers at the bottom, the Y-axis. It's just a scatter plot. Do you see? It's very difficult to tell with the naked eye which one has a stronger relationship. Probably, if you look very closely, it's probably that one that has a stronger relationship than that one. Because can you see, you do get some variances away from a perfect linear relationship, whereas here they're slightly smaller. But to what degree? Do you see, you start getting into stick your finger up in the air guesswork, and we don't want to do that. We want to have at least something that, and ease as well. We want to be able to just in one click of a finger, yep, I can see straight away. You know, like this one might be 96% strength, positive strength. This one might be 80, and I don't know. Do you see? I'm just guessing. Is it 80? Is it 82? Is it 90? I need some way of calculating precisely, or as you know, statistics is obviously about not 100% precision, but you know, statistics is statistics. Obviously, there is going to be some flex and error around it. It's trying to find at least some framework that we can use, reasonable framework within some confidence intervals. However, we need a number, basically, right? So to do that, let's calculate it. Instead of us having to, and again, I know I keep repeating the point, but I really want you to understand why we're doing this, rather than you, when we get on the charts shortly, you just see a number, and you're like, oh, well, I'm just taking that number just at face value. No, I want you to understand how that number was derived. Where did it come from? But the reality is, we don't have time to derive that. We don't have time to do a scatter plot every single day, every single hour of crude oil versus the S&P in the same way, you know, ice cream sales. You may have a manufacturing company that wants to see some sort of correlation between their, you know, they might be running an ice cream business, and they may not only want to compare against temperature, they could want to compare against anything, you know, footfall. When footfall increases in the shopping centres, do we sell more ice cream? Okay, then we need to focus on those shopping centres where we have more footfall. Most likely they will see a positive relationship. But it also could be, if footfall, you know, gets too high, do we start to see a deterioration? Do you see? But to do that, they need to have some sort of way of measuring this in an easy manner, which they can then make decisions on, right? So I keep repeating this point, but I just want you to understand why we do go and just take one number, and we don't do this long form. However, to get to the number, it has to be done somewhere. So we'll let the computer do it, as in I let Sierra Chart do it for me. But it's a fascinating exercise, because I want you to see how Sierra Chart comes up with this correlation coefficient, because I just don't want you to see it as a number. Okay, so I've gone on and on a bit there, but hopefully you see it is for your benefit. Now, the way I'm going to do this, I want you, if you can, to do this manually. So I'm going to have to move this a little bit. As in, I want you to maybe rewind. I'm not going to do it the same way I did with this. Just obviously, I know just see here, recording's gone on for quite some time. And obviously, I do want to move on. We've got a lot to cover. And it's much easier for me just to copy and paste. But what I want you to do is I want you to go through the whole exercise again. You know, so you can put all these out. Like that, variance A. So what I did there, I just copied and pasted. So I'll do that for you again. So copy and paste. Paste. Okay. And I want you to do these, the variances, right? So the averages. Now I'm just going to copy. I'm going to cheat a little bit. Copy and paste. Okay. If I copy and paste there. Do you see it worked out the average? Can you see that is... Sorry, I pressed the wrong button there. That is the average of the S&P 500. So don't forget, this is S&P 500 versus crude oil. The averages of S&P 500 for this range of data, 1, 2, 3, 4, however many it is, I think it's like 10 or 11, 12. It could be 12 hourlies, like hourly data. Probably not, because it's moved 1100 points in one day then, but or it could be daily, you know, day 1, day 2, day 3, month 1, month 2. It doesn't matter, right? It doesn't matter. This calculation works in the same way, regardless of the actual period. But the average is 5050. The average of crude oil is 96. And then want you to calculate all these individually, you know, so you do one minus the other. So let's copy. Don't forget, go back to the variance section in the pro course. If you may not have ever done the pro course, that's fine. Then I would highly suggest wait till you finish the pro course. If you're not doing the pro and foundation course, you may just be doing the fundamental course as a standalone, as an overlay to your existing edge, which you may not have got from pro and foundation. That's fine. Then just do some reading around the standard deviation. Let me just write it down here. Standard deviation and variance, okay? Because, I mean, I spent 2 hours explaining this in the pro course, so I'm not going to repeat it here. And you can find it on any basic statistics website, right? So just repeat that. Standard deviation and variance, how they're calculated, what they are. It's volatility. We want to see how volatile or how much something varies, right? Because institutional traders and statisticians are using this all the time, and I've mentioned that many times in that section. What we're doing here is we're taking it to the next level. We're seeing how much the variance is. So can you see 4,500 varied from its mean by 550 negative. So, you know, that might be the plot of the S&P 500. That's the average. On this day, let's call it a Monday. I'm just making this up. Could be a month, it could be January. On Monday, the S&P 4,500. Do you see it varied from its mean massively negatively? It gives us a benchmark, a reference point. Do you see, in qualitative words, to an extent, it's very difficult to put words into any sort of actionable actionable things, because if you think about it, I could say to you, yeah, the S&P was negative today. Well, hang on, how much? How negative? What was the magnitude? Do you see, this allows us in a number to say, yeah, it was negative 550 points from its mean, okay, on average versus its average. Do you see why variance and standard deviation allows us to measure correlation really nicely? Because if I want to compare the S&P on Monday to crude oil on Monday, what's the easiest way for me to do it? Compare the variances, right? Because the S&P varied from its mean by a big negative amount. If crude oil also varied from its mean by a big negative amount, I've got a relationship. Can you see? If the S&P varied by a negative amount, a large negative amount, but crude oil didn't really move much, do you see there's no relationship? So by comparing these two variances in S&P 500 and crude oil, I can now see the relationship, right? How much did they vary? Did they vary by the same amount from their respective means? If they did, great, I got a relationship. Okay, and it works both ways. Obviously, if one was negative, one was positive, then we have a relationship as well, but a negative relationship, inverse relationship. Here you can clearly see straight away it's a positive relationship. Why? Because generally, and you can just eyeball it as well, can you see whenever the S&P 500 varies, so wherever we have very negative days relative to the mean, crude also has negative days. Do you see that? Minus 16. Or months or whatever. Look, minus 350, the variance, minus 16. Look when it's positive, when the S&P has a massive up day relative to its mean, 5,600 versus the average of 5,050, what does crude oil do? Oh, look, crude oil also has a massive up day. You see, it's beautiful because it allows us to see not only do they both have up days or down days, do they have them on the same day, and to what magnitude? And that's what this tells us. Do you see, is it strong? 96%. If this went up a lot, the variance was very high, and this was very tiny, what would happen? The correlation coefficient might be 60%. Okay, that is covariance. Okay, it's all about covariance. Honestly, think this through, pause it, think it, take a few days. When I understood this, and I'll be honest with you, I'm not particularly, I'm not the smartest person in the world. I just put in hard work. And part of that hard work was, I didn't understand correlation at first when I was very fortunate. I did study statistics to a very high level. Obviously, school, university, business school. But I was one of those, just like maybe most students, where I was just like, well, you know what? I just need to know what I need to know to pass the exam. But as I started progressing, right, through my kind of university and I guess business school, something clicked in me where I realized, if I want to develop a career in this, I can't just look only at, on paper, just what is the calculation, what's the number. I need to just really think about the meaning. Why am I looking at this? And I used to get very daunted by this and think, oh my God, all these calculations, it's quite complicated. Let me just know the calculation and then I can put that on my exam paper and I'll get the mark, and great. But actually, when I started thinking about this, I realized, it's actually not that daunting if you think about why we are measuring covariance. When you see this formula, covariance of X and Y over the standard deviation of X times standard deviation of Y equals correlation, this number. At first, when I looked at this, I was like, oh, what is this? I'm never going to get this. Okay, let me just do the formula, put it on the piece of paper and I'll get my mark. Thank you very much. then I started thinking, no, you know what? If you really want to understand correlation, and you need to understand this covariance, and honestly, when I started thinking about the covariance, it just made so much sense to me. It was like, okay, that makes sense. Now I actually understand correlation, and it's not as daunting as I thought. And actually, it's a very useful statistic. I understood its limitations. I understood its power. You know, I just started to understand it very, very well. And I want you to do that. That's why I'm going on and on. Because I don't just want you to do these calculations and say, hey, Envy told us, oh, great, I got this number and I'm just going to use that. Understand, right? Don't want you just to say, well, this is what Envy told us to do, so I'm just doing it, this number. We need to understand that what we're doing here is we are measuring the variance between asset A and asset B. And it makes so much sense to do that. That's all covariance is. That's why I want you to do the calculations, right? So we've got the variances and we multiply them together, because by multiplying this times that, it gives you the relationship. Because if one is positive, as we just discussed, and the other one is positive, and they're both positive by a big amount, when you multiply them together, you're going to get a huge amount of correlation. That's why when the covariance, which is that, is big, we're getting a big relationship, and that will reflect in this number. Okay, so do you see, this is not complicated at all. Covariance over standard deviation. Okay, because all we're saying is the bigger the covariance, the bigger the correlation, right? The bigger the number when you multiply these together, positive or negative, right? So if they're both have big down days together, what would you expect? High correlation. If they have very big down days together, higher correlation, right? So you multiply them together and you get a big number, and then you add them up. Okay, and the bigger the number on an absolute basis, you're going to see why we need to divide by this. This bit we haven't tackled yet, but you'll see why we need to divide by it, because it becomes very hard to compare. Okay, so for example, if I want to compare the strength and the relationship between crude oil and the S&P 500, and for example here, ice cream sales and temperature, do you see? So let's do the calculation. Okay, so let's do one times the other. So I'm going to copy this. I want you to do it by hand. There you go. Okay, so I start getting all these numbers, right? The sum of which, I'm going to copy, cheating a little bit, I'm just copying this. I want you to do it by hand. 63,500 is the covariance. How do I compare 63,500 to 5,300? Do you see it's meaningless? On an absolute basis, great, I can see there's a high correlation, but what does 63,500 mean? It's just like a big number. I need to standardize it. Remember, same as the standard deviation, needed to be standardized. So that's why I then calculate the standard deviations of each. Okay, so we do a squared. So I'm going to copy all of this. Okay, I'm going to cheat a little bit just to save time. Okay, a squared. Okay, and then I'm going to do the sum of both. In fact, I'm going to copy all of this. Okay. And let me just make that one decimal place. And that as well. Okay. Now I have the standard deviation. Okay. Copy this. And paste. Okay, so what we've done basically, and I did just copy and paste it, but it's just really to save time. So I've done the sum of variance A times variance B gives me the covariance. The sum gives me the covariance, 63,500. It's the sum of all the individual covariances. I've then calculated the standard deviations, so 1195 and 62. So basically, the easiest way to do this is think of it like this, the formula. Okay, so we've got the covariance. We know they covary together by a large amount. But how do I make sense of that into some sort of standardized format? That's why I'm divided by the standard deviation, okay? The sum of the standard deviation. So I multiplied, and then got the standard deviations, okay? So do you remember, so let me just repeat why we do this. Because remember the variances, if you take the sum of the variances, you're going to get 0. Okay, there you go, 0, right? Because obviously your average is in the middle, the disparity of all, and I talked about this a lot in the standard deviation section, again in the pro course, or you can go and read about standard deviation and variance in basic statistics, right? So you have to square them. You have to square them so you can actually get the deviations, right? Otherwise you won't be able to get the sum of the deviations. How is the strength of the deviations, basically, on an individual basis, right? So you get some crazy numbers because you're squaring them, okay? That's why you then need to square root them, okay, to get the standard deviation. So for the S&P 500 is 1195, for crude oil is 62, okay? Then you multiply them together, so 1195 times 62, okay? Okay, gives you a sum, 74,599. So what it's doing, do you see, it's giving you a ratio, okay, of a standard deviation to covariance, which you can then, it's basically standardizing it, right? So what it's allowing us to do, it's allowing us to compare the variance, the covariance, 63,500 to this number, 5,325. It's standardizing it, okay? So if you do 63,500 over 74,599, which is this number here, okay, which is the sum of the standard deviation, do you see you start making the number more manageable? You get 0.85. Do you see here you got 0.96 when you did 5325 over 5561. Okay, this is by taking the sum of the standard deviations, you're standardizing this 5325 into a number that goes between -1 and 1, okay? By doing the same thing for S&P versus crude, you're standardizing 63,500, which gives you a number between -1 and 1, okay? And in this instance, it's 0.85. What it means in a nutshell, right, is, do you see how this is not a straight line? So there is some variance. It's not a perfect correlation, right? When S&P moves up by 1%, crude oil doesn't move up by 1%, okay? On average, what it's ultimately, I guess, saying is crude oil might move up by a different amount, like 85% of that amount, okay? So it's kind of can be, it's the strength of the relationship. I like to think, I mean, people think of it in different ways. I like to think of it as, it's kind of like a 85% correlation. It's not 100%, you know, otherwise it would be a straight line. You'd get a number of 1. It's 85% strength. Okay, that's the way to think of it. Do you see here? Do you remember we said before? I said I suspect this has a stronger relationship. Do you see they're a bit tighter on the scatter plot to each other? To a linear relationship? Do you see these are a little bit wider? So some days, look, on this particular day, you had quite a bit of a move in the S&P 500, but it wasn't reflected in a similar type of move in crude oil, and therefore it was slightly off the line. So can you see, it's not perfect. So it makes sense that this is 85% and this is 96. It's a stronger relationship, right? And you can almost see that with the naked eye. But the problem is, most of the time, it's very difficult to tell them apart, or have the time to do all of these calculations whilst the market's moving. So what our Sierra chart to do is, it will just give me this number. We'll just say, right, relationship between crude oil and S&P today is 70% or 60%, and so on and so forth. A lot of this might have been a little bit overwhelming. I just want you to go back and you will get it. The point is this, and I'm going to keep repeating it. Just make sure this is recording. Be a disaster if it wasn't. Just give me 1 second. great is. The point is, I don't, and I hope, you know, it sounds like a broken record, but it's true. I don't want you to take this 70%, 60% number. My biggest fear about correlation is I don't want you to take this number 60%. When Sierra Chart gives it to you, and you just don't have a clue how it's even calculated. Do you see, you don't need to do this ever again, okay? Just do it once. Hear me rambling on correlation, covariance, multiply standard deviations, whatever. Just do it once so you understand. Oh, I get it now. When it says 60%, when it says 85%, what it's doing is plotting the variances, trying to find how strong the relationship is, standardizing those covariances into a number between -1 and 1, or -100% and 100% strength, and it's telling me what this relationship is between them. Okay, so now let's go and calculate very quickly for the others, and I'm just going to make sure I'm not blocking anything. So look, with this, would you agree? You expect this to be quite a strong relationship, but negative, right? And in fact, Excel has this formula, equals correlation, where we can just double check that our calculations are correct. Excel will just have a formula, it will do it for you. So let's paste this in. There you go, perfect. So I know my calculation is correct, 85. Excel, funnily enough, it just does it straight for you. Correlation of a bunch of numbers on the x-axis versus a bunch of numbers on the y-axis. Excel will calculate it for you straight away, 85. Instead of you having to go through all of this. But I want you to do it, you know, a few times. I keep saying that. I want you to do it, okay? Very, very important you understand. Correlation. Copy. Don't be like everyone else, you know, just doing it blindly, essentially. Sorry, let me just do that. It seems to be a... There you go. So the average format. There we go. Just format that. There we go. So the average, so now we're going to move on to the average rating, right, versus the ad length. So we said if an advert is very long, we expect the rating to be low. So it's a negative relationship, but very important. Doesn't matter if it's negative or positive. We want to see a strong relationship that we can then use to make money off. Obviously, this is advertising, and you know, obviously we can apply this to markets as well. Because sometimes you'll see the relationship between crude oil and S&P isn't positive. Sometimes when, you know, so in this example, crude oil goes up, S&P goes up, they go up together. What if crude oil goes down when the S&P goes up? Does that mean we just ignore it? No, it's a brilliant relationship we can use. Instead of buying the S&P, right, when, just get this pen out. So this type of relationship is positive. So, you know, you might be trading the S&P, you see crude oil shoot up, and you're like, all right, positive on the S&P. I want to buy the S&P. If the relationship was negative like that, like this, so this was crude, and this was S&P, and when the S&P went up, okay, crude oil actually went down. Does that mean we ignore it? No. In fact, it's just as strong as this relationship, if not stronger. Look at that. Very strong relationship. What that means is when crude oil goes down, this time we're positive on the S&P, as opposed to when crude oil goes up. Okay, that's all. Don't get put off by the negative sign. If anything, it's a good thing. It's a relationship. We're just looking for a relationship one way or the other, and then we decide how to utilize that relationship. Okay, so let's do the calculation quickly for this. Right, we've discussed it to death. I'm not going to bother calculating all of this again, you know, one by one. So I'm literally going to cheat, and I'm just going to copy all of this. Copy. In fact, let me just move this chart a little bit out of the way. Just going to move it there. Okay, so I'm going to copy this. I want you to do it by hand, okay? I don't want you to do this. This is why I'm just cheating. Paste. Alright. If you do the copy and paste, you'll see that you'll just need to change this formula because it's using the average from above. So just drag it down. I'm just telling Excel I want you to use this average, because obviously add length average versus the individual add length. And then same here, need to drag that down and use that add length, and then copy and paste. Again, I want you to do this slowly. Okay, there you go. Alright, so what have we found here? Basically, can you see you can even eyeball it? What it's saying, it's the covariance. Don't forget how important this is. Covariance is correlation. How much of the variances relate to each other? Well, let's see. When the add length is below average, measured by variance, -6, where's the average rating? Above average. So when you multiply them together, you get a big negative number. So it's a strong negative relationship. Okay, you can see that. Look, 10 versus the average 4 is very high, positive. 16 versus the average length is very negative. So every time we get a negative, look, can you see you get positive? Negative, positive, 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 negative. This time it's the other way around. Right, so when the add length is too long, 4 seconds above the average, the rating is below average. Fascinating, right? This covariance. Not only fascinating, but very simple to understand. Right? When you multiply them together, you get a big negative number. So you get overall, then you sum them together, sum the covariances, you get -111. You then take the squares of the individual variances to get the standard deviations. Okay, multiply them together, 114, and then you see all you're doing is -111 over 114 equals. Because otherwise the problem is, do you see, okay, it's negative, but how strong is this relationship relative to that, How do you compare them? I can't compare -111 to 63,500 to 5325. Do you see why we standardize it? By dividing by the sum of the standard deviations, which then gives us a number between -1 and 1. This, same thing. I'm just doing 63,500 over 74. The sum of the standard deviations gives me a number between 1 and -1. 85% strength. 96% strength. Look at this. So when I do -111 over 114, and I want you to do this yourself slowly. I've just copied and pasted because I want to move on. Look at that. I get -0.97. So it's 97%. Look at that. So strong. But on a negative basis. Okay, and you'll see these type of relationships between crude oil, S&P, sometimes crypto, and this is the type of relationships we're looking for. Okay, one versus the other. This could be crypto, could be gold, this could be S&P, could be FX, right? Any number of relationships. All we're asking Sierra chart or whatever it is to do is plot the relationship on a scatter plot like this. This is a scatter plot. Right? We don't know what it could be any type of scatter plot. It could be all over the place. It could be positive like this. It could be negative like this, right? And we're then saying to Sierra chart or your platform or whatever it is you use, give us the correlation strength. And then what it does is it works out this. The variances. How do they co-relate, co-vary? Gives us this one number, which is pretty meaningless in itself. It's a big number, great, but you see it's hard to compare. Let's standardize it and make it between -1 and 1. Wow, now I can compare. Okay, this relationship is 97% strong. It's stronger than this relationship, 85%. Do you see? I can now start to compare. Okay, so probably said it many times. Apologize if I've said it too much and this is so obvious to you. I don't know. Never was to me. Took me some time. I was never explained to me like this. Even when I was studying maths, for some reason, no, you know, I mean, great teachers, obviously nothing against them. But I don't know why. I think I read this in so many books, statistics books, and then eventually just clicked. I had to kind of figure this out. But I don't want you to go through what I went through, where I was just looking at correlation blindly and I didn't really get it. I just knew it was a number and I was like, yeah, that's strong, 90%. But what does that mean? It's basically the strength in the relationship between the variances of the two How do they covary? Like this, okay? And the nice thing about it, to see it like this, is you then start to realize, okay, I know there's a 90% relationship, but I can't, when I'm trading, I can't take it as gospel, because I might get days where the relationship breaks down. Do you see that? Do you see you get these outliers, okay? So you might have a nice relationship, like a terrible straight line. Do you see, some days the relationship might break down. You have to be very careful. You can't just keep trading it blindly. Understand the limitations. That's why I wanted you to go through this exercise, so you can see. Sometimes you're going to see examples, and let's have a look at some of them. Do you see this? This relationship? In fact, this is a fantastic example. Let's do this one next. So what we're going to do, again, we're going to cheat a little bit. I'm just going to copy that. So this is S&P 500 crude oil, but maybe on a different week or month or whatever. It's just a different set of data. See, the relationship is slightly different. Let's actually compare that to... This is what you're doing, essentially, when you're looking at correlation as a trader. See, this is crude versus S&P, say in January. This is crude versus S&P in February. We need to really think about this. So this, I'm just making this up. This could be January. I don't know when this data was. January versus February. Okay. Which one do you think has a stronger relationship? Pause the video. Think about it. Okay, you've paused it. Clearly this one. Do you see, this one has a little bit more wild outliers. Days where the relationship just completely broke down. The point is, and again I keep saying this, firstly it's very difficult to visualize this. So you need the software to come up with a way of plotting this for you. Because what are you going to do? Well, you can get pen and paper and plot this every single day. This scatter plot. No, it's completely irrational to do that. So you've got to allow the platform to do it for you. But most people are too lazy to even... Then they just let the platform do it. And I keep saying this. Now you know what the platform is at least doing. It's doing this scatter plot. Then it's doing what? How much do they vary, co-vary? And what that allows us to do is see the strength of this linear relationship. You know? Here we can see it's slightly weaker. Do you see? They co-varied less on these days, which is going to drag this correlation number down. Okay, so can you see the correlation is weak here? Problem is, I don't know how much, right? It's no good just visualizing it, because I don't know. This might be 90, and in fact we know it's 90, I can't remember what the number was, somewhere in the 90s, and this might be 60, but is it 60? Is it 65? Is it 70? Is it 75? Is it 55? That's why we need to allow it. You know, I'm not a big fan, as you know, of indicators and just numbers being calculated, but as long as we know its limitations and we use it on a discretionary basis, right, and we apply logic on top of it, you know, we don't let the number rule us, but we understand the number and then make an interpretation, an intelligent interpretation, then these type of statistics are very, very useful and vital, in fact, because it saves us hours of having to work things out for ourselves. So we're going to now, that's why I want to show you that this correlation, the covariance that we've been calculating, it will help us to determine the difference between the strength of this relationship up here between S&P and crude and this relationship on a different month or a different year. We can now compare them. Okay, so let's go down. So what I'm going to do is I'm going to cheat a little bit and I'm going to just copy and paste it as I said. Okay, copy, paste. Where's it gone? Paste. There you go. Okay. Alright, now don't forget, this is using the average from above, so if you do cheat a little bit, make sure you move this, okay, because it's locked into that cell. Just a little quirk of Excel, Microsoft Excel, you just need to move it down so it uses that average. Hit enter. Okay, now don't forget we're expecting what? The correlation to be lower, right? I'm going to keep repeating this, so I want you to get it. But you expect the relationship to be weaker, right? Because can you see there's some days where they're just all over the place. It's not as neat as that. It's not as strong as that positive relationship. It's a little bit off. Okay, so we would expect the correlation to come down. Is that what we see? That's why I want you to work through this slowly. Okay, so we've done that one, and then don't forget you just got to change this one as well, because it's using this average. Come down. Okay, don't forget we can test this with the relationship, the correlation formula anyway, just to make sure we haven't made any mistakes in our calculations. You then need to just copy this down. You can use this little corner, or you can copy and paste. Right, you can copy and paste. Okay, let's just, so I'm getting 46%. So it's actually not that strong a relationship, which is no surprise because we get these little massive outliers. So let's do the correlation formula. Equals correlation, double click that, array 1. So I'm asking Excel to do all these calculations for me just to save me a bit of time, and so I can compare. Sense check, hit enter, 46%, perfect. So the calculation is correct. Can you see, it's a fantastic way of comparing this period in the S&P 500 versus crude oil to that earlier period. This period here was very strong, 85% correlation. And sorry, I said 90 earlier, but it's 85. And you see this, 46%. Do you see? So I can now make an intelligent decision and say, you know what? I might be thinking to myself, right, Envy, today, or this week, or this month, the relationship is at 46% strength. And in fact, let's drag this up. So just remember this number, 46. And I'm going to repeat this one more time, okay? And I know it's a bit annoying, but 63,500 here is the covariance. I've got 40,000 here. You see, it's very difficult to compare the numbers, right? So this is nice, 85, 46. So I'm going to compare the two. So what we're basically saying is the relationship, the covariance, the correlation here, let's say it's week 1. I'm just making this up. It could be week 1, it could be January. Let's call it January. Let's call this week 2 or February, right? However you want to think of it. Could even be a day, right? But the date is obviously jumping around a lot, so it probably isn't a day. But you can compare it on a day as well. You're going to see I actually look at it on an hourly basis. When we're on Sierra chart, I look at it on an hourly basis. This relationship, my memory is terrible today. Forgotten. 46%. Right? And this was 85. 46 and 85. 46%, 85. Right? So straight away, I don't need to do the scatter plot. I don't need to do anything. I can just tell him one number straight away. Let's say I'm in January and I see the relationship is up at 85%. Straight away I can make a decision that, alright, I'm not going to place as much weight on correlation between S&P and crude. And if I see crude oil in January shoot up, wow, we've got 85% relationship strength. That is very powerful. I'm going to use that. I'm actually going to pay a lot of attention to that. In February, if I see crude oil, the data is just down below, shoot up like this, I'm not going to pay as much attention to it, okay? Or if I see it shoot up here, or change, basically, I'm going to pay as much, shoot up or shoot down. I'm not going to pay as much attention to it, because actually, the effect on S&P, do you see, it's off center. It's going to be a bit more unpredictable. Whereas here, based on history, if crude goes up, it's likely based on this month's history that I may get a strong 85% strength move, equivalent move. Whereas here, it's like 46%, right? Which is still a very strong relationship. It's still a very strong relationship and worth paying attention to. But I can at least say, okay, I won't pay as much attention as I did the previous month here. Okay, so hopefully that's making sense to you. Really, really useful statistic, correlation, if you understand its limitations. And when I say that's the most important thing, a lot of people look at correlation and they just use it blindly and they don't understand that it's not perfect. 46%, okay, great correlation. But you've also got to understand as a trader, some days, do you see here? The relationship can break down, okay? It can break down. That's really the most important thing to understand. Some days it's going to be great. Your job as a trader is to allow yourself the flexibility, the space to understand that, okay, relationship may break down here, okay? And that's what these numbers allow you to do. Start to make interpretations, but also to understand what they're telling you, okay? So I'm just going to finish off now, and I want you to go through this very slowly, but I'm going to be quite quick. I want you to really think about, what would you expect the correlation here to be? The covariance between, not only logically between shoe size and someone scoring a test, we said this before, and they'll all assume that they're the same age, say 30. We would expect no correlation, but is that what the data's telling us? Well, we can see. Look at the scatter plot. It's all over the place. There is no relationship. It's a very unreliable. You can't make head nor tails of this. I would expect this to be close to what? Between -1 and 1. Would you agree? You'd expect to be close to 0. No relationship. Well, let's have a look. Let's have a look. Okay. So what we're going to do, I'm going to just cheat a little bit, and I'm going to copy all of this. Okay, hopefully I've left enough space there, I'm not sure. Paste. Yeah, just about enough. Okay, and don't forget, we've got to change these reference points for the mean. Okay, that. Again, I want you to go very slowly and think about this covariance. It's really not that complicated. What is it actually telling us? Right, can you see it's very random, basically. You can even eyeball it and see that they covary. Look, sometimes it's negative. Sometimes it's negative and this variance is positive. Sometimes it's negative, positive. Sometimes it's negative, negative. Sometimes it's positive, negative, positive, negative. Right? It's all over the place. Sometimes it's positive and positive. Do you see the variances? There's no pattern to them. There's no pattern. Very little pattern. They're all over the place. So we would expect the covariance to be quite small. Right? And it is 5. But to be fair, it's difficult to compare 5 to -111. It's meaningless, so we standardize it. Remember that? Work out the sum of the squares, right, as you do for standard deviation. Multiply them together, and you get the standard 597. Okay, so now what do? Compare 5 to 597, and what do you get? Virtually 0 correlation, 0.0. Now I can compare. I can compare 0 to 85%, to 96%, to -97%, to 46%. I'm getting 0 correlation. It doesn't have to be 0. It might be like 0.1, right? Even that's very low correlation, 10%. Very little explanatory power. I really won't pay much attention to it. 0.1, it's like 1%. Peanuts, no correlation at all. We can do the formula, so copy this. Should come up with 0.01, hopefully it does. Yep. So that's Excel calculating correlation of, okay, these two, the arrays. It's calculating it for us, 0.01. So basically what's that saying is, the correlation statistic is telling us these things don't covary together. I can't find any relationship. There's no, when one goes up, one goes down, they're all over the place. And I can't fit a line, it'll be like that. Well, it's all over the place. Sometimes someone's shoe size is very big and they're getting a low score. Sometimes someone's shoe size is very small and they're still getting a low score. Sometimes someone's shoe size is big and they're getting a high score. Sometimes someone's shoe size is small and they're still getting a high score. There's no relationship, right? It's not like this, a neat relationship, 97%. Okay, so what I'm going to do, we're almost done now. And you know, some of you may have felt I went through this way too slowly, some of you maybe not, but hopefully either way, right, who cares? I'd rather go through slowly than too fast. I'm going to quickly just cheat a little bit. I want you to do this on your own. Think about which is stronger, right? We can actually see it. Won't always be the case. Sometimes it's very hard to tell. In fact, very difficult to tell, right, on these two. Accidents per 100. Hopefully I'm not blocking it, but I did this intentionally. How do you compare which one has a stronger negative relationship? You know, as people get older, they have less accidents. As people get older, they have less accidents. These are two different age groups. Which one has a stronger negative relationship? I find very difficult to tell. I cannot tell between that and that. And even then, can you tell the actual strength? I can't. So I need to calculate the covariances and then standardize them. So again, I'm just going to cheat a little bit. I want you to do this very slowly. Just going to copy, just make sure I'm not blocking anything. Probably will end up doing. Copy that. Paste it in here. Just need to quickly, the averages as well, isn't it? Copy the averages. Okay, it should be very clear to you what I'm doing here now. We're just comparing the variances. Okay, so that one actually was done. That's fine, so you don't need to change that. Minus 84%. Alright, so it's calculated. Let's just make sure I haven't made a mistake. Copy the Excel formula, paste it here. Minus 84, perfect. So I'm asking, so the relationship is negative and the strength is 84%, which kind of makes sense. It's not perfect, so it's not going to be 100%, but it's fairly strong, right? Now I'd expect this to be negative as well, but how much stronger? Is it more than 84, less than 84? Okay, well, let me just copy. So again, I'm going to do something similar. I'm going to we've already got the averages there. Copy. Okay. Just make sure I apologize if I cover any of this with my head. I do, don't I? What is something's doesn't look right. Minus 29. Yeah, it's using the wrong average, isn't it? So it's using the average of the table above. Just move that down. We would have picked up on that anyway when we got Excel to calculate it for us. That's why it's good to have a sense check, just to make sure you haven't made any mistake in any of the formulas. Just going to copy that, paste it down. There we go. Minus 88. Let's copy that. Okay. So do you see the difference between the top and the bottom? This has and in the grand scheme of things, you know, when you're looking at markets which fly around a lot, 88 versus 84, they're as good as each other, if I'll be honest with you. But can you see with the naked eye? Very difficult. Could you really have told this had a stronger relationship? I can't. In fact, initially I actually thought that had a slightly stronger, because some of these are closer to a straight line. This has got a couple of outliers, but actually this has a stronger relationship overall over the period. This is 88%. This is 84%. Okay. Do you see in real life why organizations, governments, scientists, statisticians, people are using this stuff heavily? Because they can make decisions versus relationships, not only on an absolute basis, but relative to other data sets, relative to each other. You know, this works. Doesn't matter what you're comparing, whether it's shoe size, scoring a test, accidents. You know, this could all be S&P and crude, crypto and S&P and FX on all different months, right? Let's imagine this was all different data, and this is the final point, then we're done. And actually, this is the ultimate conclusion I want you to realize. Ignore that it says ice cream sales, right? Let's imagine this was crude versus S&P. All of these, this, they're all crude versus S&P. This is January, that's February, that's March, that's April, this is May. Over time, do you see now how you can easily compare using statistics, i.e. correlation, coefficients, the changing relationship, and you can use that to your advantage in trading, right? Or even recognizing when correlation isn't useful to you is just as useful as recognizing when correlation is useful to you. So you can see here in January, 96% relationship. That's what I'll look for. Say, right, I'm going to use that. It's a positive relationship. Oh, in February, it's all right. It's bit lower, 85%. All right, but it's still strong, so I'm going to use that. Here, very strong, 97%, but negative. So rather than when crude goes up, I'm positive on the S&P, like here. This time, it's the opposite. Okay, when crude goes up, I'm actually negative on the S&P. S&P might actually go down, and we've seen that happening right now. And again, you could be watching this in several years' time, and because you can see how much work I've put into this. I'm probably never gonna do this again, right? This is gonna last you a lifetime. Crude might be at, who knows, right now it's around 100, 110. Could be at 200, could be at 50, could be at, who knows where it is. Right now, crude oil is very high, so it's having a slight negative impact because crude is so high. It's pushing the S&P down because people are worried. It's eroding purchasing power of consumers. They have less disposable income to spend on going to the shops. Consumer spending is obviously lowering. They're having to spend it on energy and other items that can erode purchasing power. So it's having a negative impact on the S&P. Sometimes it's positive, right? When crude oil is very cheap, it's cheap for companies to expand, right? They're going to invest. Do you remember C plus I plus G? It's good for investment when crude oil is low, and therefore you see a positive relationship. So these things we can obviously discuss a little bit more further down the line. But how do you even make that comparison without having this number, minus 0.97? I can compare it in one number, 85%, minus 97. Here, minus 84. And then there'll be times when there's no relationship, right? And we see that here. So it could be, let's say it was January, February, March, April, May, whatever. And then down here we've got August. Let's say I'm just making this up. Imagine this was August. Forget that it says shoe size. Could just be S&P and crude, and right. So this could be crude. This could be the S&P. Right? It doesn't matter about these numbers because we're standardizing them. Remember, it's the covariance over the standard deviations. Right? Doesn't matter about these units, are irrelevant because we're standardizing the units. It doesn't matter about the prices. So just ignore these numbers. We care about the scatter plot. See, there's no relationship, 0. So, we're in August now. I've been observing correlation. It's at 0. Actually, I'm going to ignore it. When crude goes up, it's not going to worry me that much. I'm just going to leave it because this month the correlation is very poor, or this week, or this day. Or, again, the periods and maybe not. And here, slightly weaker relationship. It was around 40-50, wasn't it? So yeah, so this period, let's say this is September. This period here, actually, I'm going to pay a little bit of attention to it, but I'm not going to worry too much about it because it's only 46%. You see, relative to some of the earlier data that we had, where the relationship was very strong. Okay, hopefully you've enjoyed that. I want you to maybe go through this 2 or 3 times. I know it sounds like a lot, but it's really going to pay off. Understand covariance, correlation, because you're going to understand, a lot of people think, well, hey, I'll just take the number, I get it, it's 8.858. No, you don't. What you don't understand is, by doing this exercise, it's going to allow you to know the limitations of correlation, and that's one of the biggest things, okay? People get so attached to a lot of things that they use. You need to understand the limitations. That sometimes you're never going to get 100% relationship. The weaker the relationship, the more danger there is that when I always think this is why I've done well as a trader, I always err on the side of caution. When I have a relationship, okay, I understand the strength of this relationship and how it can help me, but I also understand the weaker the relationship, the more likelihood I might get days where the correlation breaks up, where it goes suddenly positive from negative, and I allow myself to adapt to that because I understand what correlation is. I understand it's not perfect. I understand how strong it can be, but I also understand how dangerous it can be. Alright, so hopefully you've enjoyed that. It's actually like a statistics lesson, wasn't it? I really enjoyed doing these actually. I did one in the pro course with the variance and standard deviation. Really enjoyed putting this together. I think I'm going to break this up now, obviously make this into a separate section because I don't know how long it was. It was well over an hour and a half, almost 2 hours. I'm not sure exactly how long it went on for. So pause, go back over this, make sure you understand covariance, correlation, and so on and so forth. And then what we're going to do is we're going to move on now. And we're going to start thinking about why some of these relationships exist, why they might be positive. Obviously I've said this before, correlation isn't causality, right? And we're going to talk about that a little bit. But ultimately what we're going to do now, I'm going to put the statistics to one side. I'm going to assume you understand all the statistics. And I'm going to now start just using some of this data at face value. So if we get 0.85, we get 0.96. We're going to discuss obviously the theoretical elements of it, and then we're going to talk about how you can use it, which is the most important thing. Alright, have a great evening, day, whatever it is you're doing, maybe even a week. Take some time off, digest this, don't shoot straight into the next section. Make sure you understand this. Never understood people rushing this. Doesn't pay dividends. Take your time, take a week if you have to digest this, come back to it, watch it again, whatever, and then move on. And I'll see you in the next section. See you later. Now, just one quick thing. I know you probably thought, hey, we just finally got rid of him after whatever it was, like 2.5 hours. But I might as well make it 100% perfect. There was one, because I think what I do is I do review everything. Okay, I don't just speak and then put it out there. Of course, I take this very, very seriously. I want to make sure you're getting everything and I'm not missing anything. So give you some comfort tonight. Always review everything. So I've just finished watching the whole 2.5, 3 hours, whatever. So I know what you have to go through, but I think it actually was really useful. And there was one small thing, and I think you're going to agree with me. This is very, very useful that I forgot to add. So let me see if I can just find it here. Okay, so I didn't actually use this paper, but I remembered when I was studying statistics in business school and at college, and I was learning about correlation, right? I remember there was this broad kind of table that I was always given describing how strong the correlation statistic was. So, you know what, I could probably put this, let me put this in the download section. You can have a look at it. To be honest, it's only a few pages. I go through it in 10 times more detail than any of this. And I didn't use any of this stuff. You'll see all the examples are completely different. But if you want, you can have a look at, some PhD guy, teacher or something. I don't know who this is. He's put something together for a university on correlation. You'll see the same sort of stuff, like scatter plots and positive, negative. You can see all these scatter plots and strong relationship, weak, and all sorts of stuff. And I mean, personally, I don't think you need to look at it. It's this that I wanted to point out to you. Okay, this little table he's put in here, because when I was at business school, just like this guy, I think he's a lecturer or something, this is what I was told, and I was a bit hesitant to mention it. I don't really use it myself, but do you see an absolute value of R? So that's the this correlation coefficient that we've been calculating all this time. Let me just make sure I'm not blocking anything. Nope. Okay. So this correlation, 85%, 97%, we've been going on about for a few hours now. What he's saying, this lecturer at this university, and this is standard, I got told this as well when I was learning correlation. What he's basically saying is when the correlation is below 0.3, the strength of the relationship is very weak. Okay, and same for negative correlation. I think he's forgotten for some reason to put minus 0.3. Okay, so what he should have said is strength of the relationship, if it's higher, right, it's the other way. So between 0 and minus 0.3, it's weak. Between 0.3 and... So what he's saying is, if the relationship is between 30 to 50%, the power of it, and in fact, one thing, right, and I'm sorry to do this now, but a different way, just in case any of you are still confused about the covariance and standardizing, you can see the formula here. You see, he's done it in a slightly different way, but it's the same thing. The covariance of x and y. You know what we've been doing? Multiplying the variances together. Do you see, he's doing the same thing. X minus x bar is just x minus the average of x. That's what we've been doing, right? We're taking x minus x, S&P, minus the average. Okay, and that's variance A. And you'd be multiplying it by y, which is crude, minus, here, the average of crude, which is 96. And then multiplying them together, that's simply the covariance. And then taking the standard deviations of x and y, which is these two standard deviations. So one thing I forgot to mention that you might actually find useful, right, is what the standard deviation, what this is doing, and I've not seen this written anywhere, kind of just came to my own conclusion on this. When you multiply the standard deviations, it gives you the exact covariance that would explain a 100% perfect relationship. So you can imagine every time, if S&P went up 1%, crude goes up 1%. 2%, 2%, 3%, 3%, 4%, 4%. You know, like basically, it was a perfect relationship. So in fact, he might have it in this PDF. I don't think he's got a perfect relationship. It's not in here, is it? Something like that, but just perfect. You know, like, so they move one for one, basically. Okay, so when you multiply the standard deviations, what they're actually telling you, this bottom part, so covariance x, y over standard deviation, you see this, the covariance would have to be 74599 for it to have a perfect relationship. The covariance is 63500, so it's only able to explain 85% of a perfect relationship. That's a different way of thinking of it. I've always liked to think of it like that. Forgot to mention it during the class that we just did together. So yeah, coming back to this table, anything between below 30%, so can't explain 30% of a perfect covariance relationship, i.e. multiplying the standard deviations together, is a weak relationship. Or a no relationship, really. So we had that here, didn't we? Do you remember? We had this one, 0.01. Do you see? It's below 0.3. So it's a weak relationship. 0.3 to 0.5 is... so there's no relationship below 0.3. So none or very weak. 0.3 to 0.5 is a weak relationship. So I think we had... No, we didn't do any between 0.3 and 0. Yeah, we did. You see this? So that's a relatively weak relationship. 0.3 to 0.5. 0.5 to 0.7 is moderate, and then above 0.7 or below, I should say, 0.7 minus 0.7. Okay, so less than minus 0.7. You know what? It's a bit confusing with these signs, but essentially it's, you know, like if it's minus 0.7, minus 0.8, basically greater than 70% correlation coefficient is very strong. So the point is, what he's saying in a nutshell, less than 0.3, there's no relationship. Between 0.3 to 0.5, it's weak. Between 0.5 to 0.7 is moderate. Greater than 0.7 is strong. And you're going to see that because when we get on the platform, the institutional platform, and calculating correlation, sometimes you're going to see it at 0.5, sometimes it'll be 0.7. You know, when we're comparing like crude and S&P or S&P and dollar yen, or you're going to see these correlation coefficients. So it just gives you a kind of rough idea. I don't actually like this table. I think it tries to make correlation into an indicator, you know, so oh my god, I got 0.49, I'm below 0.5, so it's weak. I don't agree with any of that, okay? I think there should be a bit of judgment, as I've said before, discretion. So here it says 0.5 is weak. Do you see here? We got 0.46. I actually think it's pretty strong. 0.46, it's not bad. You know, it's perfectly usable. Look, fairly decent relationship, right? When crude goes up, when crude rises, generally, obviously, like I said, sometimes you get an outlier, the S&P goes up. Okay, so again, don't forget, when you multiply the standard deviation together, a covariance of 87,603 would be perfect correlation, where crude and S&P were always on the same line, perfect linear relationship. Actually, the covariance was 40,000, so a little bit less than half. Okay, so 46% can be explained assuming a linear relationship. So it's not perfect. According to that table that I just showed you, it's weak. Okay, I just wanted to mention this because I want to be complete, and I want to tell you, you know, if you went to university or you went to college and you learn about statistics, you can see there's even some dangers to taking for face value what you're being told, because I don't necessarily think in the markets you can really put these perfect kind of criterion around it, saying, oh, you know, above. But I think roughly, if I was to say, I would say roughly, you know, 40 to 50% I can work with, right? Anything below, I probably wouldn't, and we'll look at that together. All right, so hopefully that was useful. Sorry, I just wanted to mention that. It was very, very important just to categorize them, because I knew I might forget if I waited until we got to the section, because we got a little bit of theory to come now. So I'll see you in the theory part.